I'm, of course, Sam Norris. I run Grand Union Finance, and the whole purpose of the live video that I put on every single Friday at 5 p.m. Friday, Monday. See, I told you, I'm just, the head's not quite there today. Monday, because with the Monday mortgage melt, is to answer any questions that you guys may have concerning any kind of finance for your property projects. Why should you listen to me? Well, as I mentioned before, I am the owner of Grand Union Finance. We are a specialist brokerage that deals with working and helping investors and developers in particular. That's our speciality, and I've been doing it for 14 years now. Hence why I've got a few greys around the side of the old head. Because it's quite a stressful thing, and I'm old, as we've established, because I had my jab now. So any questions that you've got, there's no kind of limits. You're not allowed to ask this, not allowed to ask that. I can't give any kind of individual advice. But yeah, look, there's no restrictions on what you can ask me. I can't give you individual advice because obviously I don't know all of your individual circumstances, but I can offer my opinion, my thoughts. Let's kick off because we've got quite a few questions that have come in, mainly from my stories. Coming in. So we'll start with the ones from the story, because I do promise on my stories I'll always start with the ones that are on the stories. So I think I've said stories enough in that little section. So let's go straight into one, which is, to remortgage a buy-to-let portfolio, is it advisable to have additional salaried employment? That is such a good question, brilliant question to kick things off with. The answer is, I think the key one is advised. Let's get rid of the word advised from that, because every single person's situation is very, very different. The honest answer to that is it depends on how big how large the portfolio is. If you've got quite a big portfolio, and by that I mean sort of 20 properties plus, and it's giving you a decent income, most of the lenders that we'll be going to are going to be pretty cool when it comes to the just looking at your rental income. It really helps if you've got at least 2 years worth of self-assessment tax returns in order to show sort of a previous income. And if it is above 25k a year, that's also going to help as well. But if you are just starting out and you're growing a portfolio, realistically, we're not going to be able to just rely on that rental income. And you're probably not going to have 1 or 2 years worth of tax returns to show that income either. If you're doing it in a limited company, you probably don't have more than a couple of years accounts either. So having some kind of income, employed income, will make life easier for you. So if you are a relatively new investor and you're looking to build a portfolio or start getting into property as an investor, you've got aspirations to be an investor, really, the longer you can keep some kind of employed income, the more helpful it's going to be. Not just from a buy-to-let mortgage perspective. Yes, it's going to tick a box, which is going to really help us. But at the same time, it gives you an income outside of property, which means all your income from property can go into building your property portfolio. And that's what the best investors do. They will have some kind of other income over here that helps them to enjoy their life. Their property portfolio is not relied on for their personal income. And what that means is all the income that's generated from that portfolio can just keep going back in and back in and back in and back in. And we have basically a kind of what's the word to use? An exponential growth scenario, whereby, with every new property that you add into the portfolio, it adds to the income that portfolio generates, which then leads to having more income available to help build that portfolio, which helps you buy another property, which adds to it, and so on and so forth. And eventually you will get to a point where maybe you can switch your income, and you can, if you are self-employed, for example, maybe just that income from your self-employed business can then just go into building that business, or it can go into helping you buy more properties, and then you can switch to taking a small income from your property portfolio. But the longer you can hang on without taking income from your property portfolio, the better, really, in my personal opinion. And also from a mortgage perspective, having an income that's from employment on the side that's above 25k is basically just going to tick that box of every lender, and it's not going to restrict us from a lending point of view, because there could be other things that restrict us. So, you could have poor credit, or the rental income might not be that good. So we have to look at lenders that have a bit more of a flexible rental calculator. So what we don't want is we don't want the employed scenario to be the reason why we're restricted when it comes to lenders. We want to keep that as open as possible. So if you can, that's what I would do. So that's the answer to that question. So hopefully, whoever it was that dropped that in my stories, Instagram no longer tells me, which is a bit weird. I hope that helps. So let's move on to the next question, which is from TX Wonga 14. And this question is it possible to get 100% bridging finance or on smaller refurbs, or is it only for big developments? Very, very good question. There are a few different answers to this question. Okay, so first and foremost, I think there's one lender off the top of my head that will actually go to 100% funding on the value of a property if there's going to be a refurb. From memory, I think they're struggling at the moment in terms of lending, so they're not really in the market, shall we say. So the reality is at the moment on smaller refurbs, you're going to be restricted to 90% at the moment. Loan sizes will need to be above 100k, and the amount above 75%, so the bit between 75 and 90, so that 15%, can only contribute to the cost of the work. So if your cost of the works is actually lower than 15% of the purchase price, they'll only lend you that amount. They won't lend you the full 15. So it's restricted to the amount of the works. So it's up to 100% of the works basically. So that you can do that. However, if you're buying a property that genuinely is below market value, so say for example, you were buying a property that was worth 200,000, but you were buying it for 120,000, let's say, just as an example, there are lenders out there that will base their loan on the open market value, so 200,000. So they might go to 70 or 75% of that amount, which will cover 100% of the purchase price. In fact, we're doing a loan at the moment where we're actually borrowing we're actually getting enough money together to cover the cost of the purchase, with from the net loan amount. So basically what that means is the gross loan amount is actually above 100% of the purchase price, and the what they're releasing, what we're actually getting in our bank account, covers 100% of the purchase price on that. But that is because there's quite a big difference between the open market value and what they're actually buying it for. So that is one way of getting 100% bridging on a smaller refurb. The other way is to utilize equity in another property. So if you've got another property that's say only 50% loan to value, we could potentially use a bit of that equity to plug the gap, and overall the loan, although technically the loan to value wouldn't be 100%, because the loan to value would be 100% of the purchase property and then a percentage of this other property in the background, so it would be a percentage of that. But you'd get 100% of the purchase price. Now, one thing to be very, very aware of when we're looking at these types of deals is your exit. If you are reliant on refinancing, or if you're trying to refinance this, so you're buying a property to refurbish and bring it into your portfolio, what we've got to look at is if you're buying a high percentage, you're borrowing over 100% of the purchase price, we've got to look at what are you going to be able to get on a 75% loan to value mortgage on the open market value once the refurb has been completed, okay? Because if that's not going to be more than the amount you've got to pay back on the bridge, the whole deal doesn't work. So my honest opinion or my advice is, yes, there's a load of opportunities out there where you can make the most of your lending options or your borrowing options, so you don't have to deploy as much of your cash, but don't do that at the detriment of the deal. Don't do it so that the deal doesn't quite stack up or it becomes very, very, very tight. In my opinion, the more money you can put into a deal, the sweeter it becomes. The cost of your funds goes down, not just because you're borrowing less, but because your interest rate will reduce as the loan to value goes down. And you'll also be able to probably pay less when it comes to legals and valuation fees as well, because a lot of the time, below 60% loan to value, some lenders don't need to actually send a valuer out. They're quite happy to do a desktop valuation, which obviously costs less in terms of time and money, and perhaps the legals won't be as heavy as well, because the due diligence levels might not be as high, because the risk factor for a lender is so low. So there's a few things to take into account there, and one thing, as I said, I'd make sure is just do your due diligence. Borrowing more is not always the right thing to do, and there are a million and one ways out there for you to earn some extra cash to put towards your property projects. So the more money you can put in, the better it's going to be. So TX, hopefully that helped. Let me know if it does. Let's move on to the next question. So another one from Stories then, which is how long is it from refinance application to the valuation taking place on average? Interesting. Very, very good question, because this actually changes not only from lender to lender, but also, what the market's like as well. Generally speaking, what we try and do, which I know isn't like every brokerage out there, but we try and underwrite our own cases, our own applications before we submit them. Now, what that means is that when before we even apply, we are looking through the entire application and checking through all the documents to basically preempt any problems. Because generally speaking, when we submit an application for a remortgage, it will have to go to an underwriter, which, depending on the lender, it could be in a queue from 24 hours to a week. To be even seen by an underwriter. We really want to get to a stage where we reach what we call a one and done scenario. So the underwriter will get the application, get all the supporting documents, understand it fully, tick it all off, and then we get to evaluation straight away. Most lenders will want to do all of their own due diligence, their own underwriting before they actually go for an evaluation, which, to be honest, isn't necessarily a bad thing, because it means that you're not paying out for valuation fees until actually the underwriting has been done. And even if you have to pay a valuation fee on application, if something goes wrong with the underwriting, which fingers crossed it shouldn't do, if we do our due diligence beforehand, you'll get that refunded to you, basically based on the fact that the valuation didn't actually take place. So essentially what we're trying to do is we're trying to get from that point of application to valuation as quickly as possible by getting the underwriting done as quickly as possible. So anything that we see that we think could pose a problem, could pose a delay, and when I say a delay, I mean an underwriter coming back to us with further questions, we try and preempt that and answer those questions in advance. So realistically, the answer to your question, how long does it take from a refinance application to valuation? We like to keep it within a few days if we can. Less than a working week is really what we're after, but it can take a couple of weeks sometimes if the lender does genuinely want to ask us a million and one questions, including your inside leg measurement. So hopefully that's helpful. So let's move on to the next question from a little question box below, which is another one from Stories. But loads of questions coming in today. Wait for a Reno opportunity around 45,000 and use cash or use a bridge on a 60,000 Reno. So I'm presuming Reno means renovation. So a BRR type project. So what they're asking here is, do I think it's better for them to buy a £45,000 property cash, or use a bridge to get a slightly higher value property? There's two answers to this, or there's two schools of thought. The first school of thought is basically jumping on the back of what I said previously, which is the less you borrow, the better it's going to be. So if you are able to purchase a property cash and then refinance it 6 months later, you're probably going to end up getting a slightly better return because you're not paying out for bridging finance. Great, bridging is there for a very, very good reason, but if you can avoid using it, why not? If you've got the available cash and you're only looking to do one project at a time, so you don't need to split your money across multiple properties or multiple projects, great, go for it. However, at the moment, the market for properties in the region of £45,000, there is such massive competition. And one thing that I'm saying to my clients, and one thing I'm seeing from my clients, is those clients that are going in slightly above, and they're, if you think of in an area, the biggest competition is for properties valued between 45 and 60,000, for example, to use this one. Why not look at a project that's worth a good price to purchase it would be 65 or 70? Yes, you're going to have to put more money in, but you are going to have less competition because the competition is all looking for properties in this sort of area and you're going in slightly higher. Now, I'm not suggesting, look at those properties and then offer more. We're talking about next category up. We're talking about these ones might have a revalue at, say, I don't know if it's 45, 70, or if it's 60, 90. So the ones that you're buying at 65 or 70 might be 110, 115 in terms of a revalue. So your return on investment should be slightly higher. You're gonna have less competition for other properties. So using bridging could be your way in to looking at properties where there are less competition. So analyze your local area, look at where the competition is, and maybe position yourself ever so slightly above that to get more options. So hopefully that helps, Mr. From Stories. That's where my question has come from in this case. So I think this might be the last one from Stories. So we'll go through this one nice and quickly as well, and then we'll get on to the rest of the questions. Thanks everyone who's chucked in a couple of questions here. Really helpful, and thanks to everyone for joining. Hopefully it's helpful so far. So last question from Stories then. I've seen a few potential properties at the next auction. How can I buy with a bridge? This is a really good question actually, because I think this is more to do with the process, which is really important to get right, because I have had clients on the odd occasion call me and say, Sal, I've got some brilliant news for you. I say, please tell me, what is that? I've just won a property at auction. Yes, brilliant, well done. We haven't analysed this deal at all, so it could be completely crap and you could have gone in slightly higher than you should have done. So always make sure that you analyse deals before you go and buy properties at auction. So what I say to my clients is, let's analyse a deal first so we can kind of figure out what our maximum purchase price should be, maximum bid, because you don't want to go in above that. You want to make sure that you're getting the formula that I use with my clients is return on cash invested, which essentially means the amount of money left in the deal at the end, we work out the net cash flow and what percentage of that amount is. So it gives you kind of it's not return on investment, because I know investors use various other things for that, but it's return on the capital invested, the return on the money that you've left in that deal. We want to reach a certain level on that, so we can do a fairly easy deal analysis just with looking at a few figures, making a few assumptions, just to see if the deal stacks up. Once we've done that, we can then look at speaking to some lenders and getting an idea via a decision in principle or offer in principle, whatever the lender wants to call it, funding proposal, some of them call it, and we can actually get some figures based on the maximum bid that we're going to go in at. Then, of course, you can go and bid and hopefully win. And if your bid does come in slightly under what your maximum was going to be, we can just rearrange that with the lender, no problem at all. But what it does mean is that we're going to have everything ready to go. We know who our lender is, we know what documents they need, we know what their paperwork looks like, we can fill that out in advance, and we can have everything ready so that the day you actually win your auction, that's the day that we can submit the application, and we can probably even get our valuation instructed as well. Because one of the most important things when it comes to bridging, and in particular when buying at auction, is that we get that survey booked in as soon as possible, because it all depends on the survey. The whole thing depends on the survey, because ultimately the underwriting we're going to know about beforehand. If there's a problem, we're going to know it, and we won't go with that particular lender that will have a problem with it. It's all down to the survey. We need that survey to come back, and we need it as quickly as possible so that we can make a decision as to how we can proceed from there. Some people, if they're really keen on a property, might even get their valuation done pre-application and pre-auction as well. Yes, of course, that's going to incur some costs and fees, but it actually does speed up the process, and it gives you an idea of what your maximum bid can be as well, because you know what the GDV is going to be, because that's what you can ask that surveyor for, an idea of what the property is going to be valued at post works if you're going to be doing some renovation work to it. So well worth doing in certain instances, but in most situations we do have to do a survey as part of the application, so the quicker we can get that done the better. And like I said, we try and aim to get that done either the first day that we submit or within about 3 working days is really what we're after when it comes to that. So hopefully that helps in terms of the last question from Stories. So on to some of your questions. By the way, guys, if any of you have dropped a question in the comments, I can't see them because I lose them as quickly as you type them out, because we've got people joining the live video and their name pops up and all that sort of stuff. So if you have put a question in the comments, please use the little box down here, because it's so much easier for me to make sure that I don't miss any, and I don't want to miss any because your questions are so good, and they're all going to be really relevant, and the answers are going to be really important and hopefully very, very helpful to everyone watching. So on to the next question then, which is from Jay Woody. Which I'm actually going to go back into the question so I can read it, because this will give it to me in full. It doesn't come up on the screen in its entirety because it's a long one. Silly prices for renovation houses at the moment. Wait for a good deal to come up, or take use of bridging finance for other properties available but at a higher purchase price. So this is a little bit similar to what we were saying earlier on about kind of looking at properties where maybe the values are ever so slightly above where all the competition is. So if you've got an area where everyone's going for, including people that are buying properties for their own residential use as well, at the sort of 50 to 100 mark, or maybe 50 to the 75 mark, look at properties where you can get it for, I don't know, the 70 or the 80 to 90 mark. And if that means that you maybe just need to borrow a little bit more, there are there are refurb bridging loans out there at 85% loan to value, 90% loan to value. If you really need to eke it out, we can look at looking at serviced interest. So instead of the lender deducting the interest at source, they can look at allowing you to make a monthly payment. So the deductions from your loan are kept to a minimum, and so your deposit is as small as possible. So there are things that we can do in order to make life a little bit easier for you. So if you do need to go up a category, if you like, it can make life a little bit easier for you, and you're going to have less competition. So yeah, in answer to your question, Jay Woody, I think with the market as it is at the moment, it's worth looking into. It's worth looking at, can I go for something a little bit higher, and can I, or maybe even, looking at a flip or something like that, where you might not want to put as much money into the deal, and maybe you can go for a higher loan to value, because you're not going to be restricted by a 75% mortgage based on the upward value. So something to consider there. But hopefully, Jay Woody, that was helpful. Give me a thumbs up or a thumbs down, or any follow-up question in the comments is absolutely fine. So on to our next question, which is from Cruel G. Which is, will we ever see your business partner? We're not sure you have one. Well, the answer to that is I don't anymore, because although he's around in the background just sort of helping out with a few bits and pieces at the moment, my former business partner has now left us at Grand Union Finance. It's a very, very mutual. No one needs to worry about it. Any current clients that are out there that are watching this, it's all been dealt with very, very well. We just had different ideas for the company, and the direction that I wanted to take it in. It works much, much better if he's out there working on his own, whereas I'm here with great ambitions to build the team at Grand Union Finance. So actually, there's a lot of stuff going on at the moment, and there's going to be a ton of exciting things happening with the company over the next year or so. In particular, we're certainly looking at maybe opening an office in the Midlands, which is obviously where I'm based, which would be great because it opens up a whole new opportunity to bring talent into the company, and that's what we want. We just want the best in the business within our four walls, helping you guys and giving the best service that we possibly can with the best knowledge. So yeah, he's not about anymore, I'm afraid, but no, it's all good. You just left with me, I'm afraid. Sorry about that. You just have to deal with me moving forward. But yeah, I think that was actually the last of the questions. I'm just going to have a quick check to make sure that I've definitely answered everything. In the meantime, while I do that, if any of you do have any questions that you want to ask, feel free. Got another couple of minutes left before we jump off. As I said, that one just comes in as Emma Fuller joins us. So Tim Poppy 51 has asked us, hi Sam, how quickly can I refinance a property once I've renovated it? I probably have 25% deposit in the property and renovation costs. So this is really a question, and tell me if I'm wrong, Tim Bobby, but I think this is a question of basically from purchase, how quickly can you actually then refinance it once you purchased it? Which is a really, really good question. Emma says, hi. Lexi says she's going, understandably so. I mean, I am very, very boring, Lexi, so I don't mind you jumping off. But Tim, this is the question of how quickly after purchase we can refinance it, which is a really, really, really good question, because most people think there's this sort of 6-month rule. And generally speaking, traditionally there has been. Now, a little bit of an insight into this. One of the reasons why most mortgage lenders prefer you to own a property for at least 6 months before you refinance it is actually because traditionally that's how long the land registry took to update its records after you purchase the property. And it makes it a hell of a lot easier from a legal point of view if when a solicitor is doing their searches for a lender, they can literally just they can literally basically just go onto the land registry and get all the details they need. Because if it's not up there and it hasn't been updated, then there's a hell of a lot more work that goes into that side of things, and the legals can take a little bit longer. So it's more of a case of lenders being a bit lazy, in all honesty. But things have started to change because number one, land registry doesn't take that long on average anymore. It can do. In fact, at the moment, it probably does because the market is absolutely insane. Never seen anything like it in my career anyway. But there are more and more lenders that are comfortable. Aaron Knightley's just joined us. Hey, Aaron. There are more and more people that are more comfortable, more and more lenders, I should say, that are more comfortable refinancing pre 6 months. But you have to be very, very, very careful with which lender you use, because just by checking through their criteria and seeing them say that they can refinance pre 6 months, or some of them call it a day one refinance, it doesn't mean that that's going to help you. And here's what I mean by that. Some of these lenders will not value the property at open market value pre 6 months. And so basically what that means is, say you bought it for 100,000 and you've done 10 grand's worth of work for it, and it should be worth 150 now. They will limit their valuation to 100k. So it doesn't actually help you, because the whole purpose of doing a renovation, a BRR, is so that you can recycle cash. If you're just going to buy a property, do it up and then sit on it for 2 years, it's pointless. It's not actually going to help you, because the whole purpose of this strategy, it's a portfolio builder. Yeah. So a lot of people say to me, but then when you do that, you've got to use bridging and that's expensive. Yeah, it's a playoff. You can't have both. You can't build a portfolio quickly and get cheap finance. That's not how it works. You've got to use the strategy that most helps you do what you need to do. Stage 1 of portfolio building is to build the portfolio. Stage 2 of the portfolio is to consolidate and deleverage. And what I mean by that is to drive down your mortgages, either by sitting on them and not pulling any money out. And so actually over time, the values of these portfolios, this portfolio properties, do just keep going up and up and up, and increase in value naturally, which decreases your loan to value, or you make lump sum payments to it. But in the beginning, when you're doing your growth, the BRR strategy is one that allows you to do that very, very quickly. Remember what I said earlier, you're not looking to take loads of money out of your portfolio from day one. So during that portfolio building time, all the money that you get from this portfolio needs to go back into it anyway. And so that's all part of it. Paying the fees, etc. for bridging is part of it. So a lot of my clients, they want to buy 5 or 6 properties a year. They're not going to do that by sitting around waiting to refinance until 6 months have elapsed. So we have to go with lenders who not only can refinance pre 6 months, but they can refinance based on the open market value. And to do that, we also need to prove that they should be doing it at open market value. And that's where we put together our valuation packs that we send to underwriters with our applications, with details, an overview of the project, before and after photos, schedule of works, before and after floor plans, if any changes have been made there, said photos, didn't I? Sales comparables in there as well, to prove that our property is worth what we say it's worth. Because don't forget, the surveyors going around and having a look at this property, they've got no idea the kind of work that you've put into it. So let's show them what the property looked like beforehand. Let's show them how much work has actually got into it by giving them a schedule of works, a breakdown of the itemized work and cost that's gone into this. That's really show them that this property has been uplifted greatly since it was purchased, even if it was only a couple of months ago. So hopefully, Tim, that answers your question. How quickly can you refinance? The answer is pretty much straight away if you get your renovation done nice and quick and we can prove that significant value has been added. You don't need to wait 6 months, but if you don't, you need to be very particular about your mortgage lender. Make sure that it is within their criteria to do an open market value refinance. That is my advice to you. More questions coming in thick and fast. I'll probably have to leave it, maybe we've got another 10 minutes. So let's see if we can whack through these. So kicking off with Emma, do you work with HMO commercial mortgages and lenders? Yes, I do. Probably at the moment about 50% of everything is commercial in some way, shape or form. Very, very, very busy in that space at the moment, Emma. If you do have any questions with regards to that, do feel free to pop them over in a direct message to me, a DM as the kids call it. I'm more than happy to help. We are actually working on, I'm not sure when it will come out, but potentially sort of an HMO mortgage guide that I'm going to try and do. I've got loads of ideas for loads of literature and guides and free stuff that we're going to get out to clients and to members of the general public as well. We're looking at one to do with buying properties in limited company, which I'm looking into doing that as a joint venture with a well-known accountancy firm, which will be really, really cool. We're going to do another one all about the legal process. We're going to do bridging, but then have a real section on the legal process. And one of the best in the business, Matt State of Fletcher Day, has agreed to help us in terms of helping us write that as well. But the HMO guide to basically how to fund your HMO project is definitely in the list as well. That's one I'm really passionate about actually, because it's one of my favourite things. I think HMOs are given a bad name. So many of my clients that do HMOs do them to such a high standard, creating such awesome housing that just hasn't existed before when it comes to shared space. And yeah, so I'm really looking forward to getting that out, and hopefully you guys will enjoy it. But yeah, when I do, we'll be getting it out to our email list. So if you want to join that, by the way, feel free to just send me a DM with your email address, and I'll make sure that you're on our mailing list. So when these guides do come out over the course of the year, you'll be the first person to know, or first people to know anyway. So Emma, if you do have any follow-up questions, just let me know. So moving on to the next one, which is another one from TX1. How do mortgage advisors and good bridging companies find good bridging companies for their clients? Such a good question. Such a good question, this, because this is why I think that there are probably, if you looked at, if there was a pie chart of all mortgage brokers in the UK, probably those that just do sort of residential mortgages and some basic buy-to-let stuff probably make up like that much. Everything else, so like 90%, maybe 80% of the market, because you can do high volume on those things because there are basically mortgage search engines, searching software that keep up to date. They're not the be all and end all. We have access to one, which is not the be all end all. It gives a rough estimation of what's out there, but then you've got to go and speak to lenders. There is nothing that exists like that for bridging and development finance. You literally just have to know who to go to. It's impossible. There are hundreds of lenders around the country. It's impossible to know every single one of their up-to-date criteria and appetite for lending, but we have access to them. I know the people that own these companies. I've worked with them for years and years and years. It all comes down to experience at the end of the day. I hate to say that because it makes me sound awful when I'm like kind of putting down newer brokers. It's not the case at all. Some of these people are amazing, but it is down to how much you're doing, how many opportunities you've got on a weekly basis to speak to these lenders, find out what their appetite is. There's plenty of times where I might put together a proposal of funding and think, do you know what? haven't spoken to so-and-so for a little while, let me send it over to them. Let's see what their appetite is, because they may well be coming back into the market with stuff like this. So it's about constantly having these conversations, constantly putting forward proposals to various different lenders and seeing where they're at with things. But yeah, there really isn't a kind of a cut and dry, easy way of doing this. You've just got to build it up over time, which is why the reality is when you're trying to find a broker to help you with this kind of stuff, TX, you want to go find somebody that's got experience of doing this. And everyone's got to learn somewhere. Everyone's got to cut their teeth doing things for the first time and second time and third time. But in reality, do you want that person? Do you want somebody cutting their teeth with a new type of finance on your deal? Probably not. It's horrible to say it because I was there. I was there, a few years back when I did my first ever bridging deal. Actually, my first bridging deal was pretty easy. I'm not going to lie. It was my second and third bridging deals that were hard, and you learn stuff as you go. There's no real cut and dry answer to that question, unfortunately, TX. The answer is that we just know. We just understand our market. We know which lenders are active because we're talking to them on a weekly basis, and that's where it is, unfortunately. Some lenders have rate sheets, but the reality is that most bridging brokers or bridging specialist brokers won't necessarily just go off rate sheets. They'll be getting bespoke terms from most of their lenders. So hopefully that answered your question.